Let's dive right in. What is SCHD and why is it so popular? SCHD stands for the Schwab U.S. Dividend Equity ETF, a fund that lets you own a slice of dozens of top U.S. companies with a single purchase. Instead of picking individual stocks, you get instant diversification and simplicity. SCHD tracks the Dow Jones U.S. Dividend 100 Index, focusing on large, financially strong companies with a proven record of paying and growing dividends. This isn't about chasing risky high yields. SCHD is built for long-term sustainable income. Its low expense ratio, just 0.06%, means you keep more of your returns. Investors love SCHD for its combination of low fees, reliable income, and consistent dividend growth. It's not a get-rich-quick scheme, but a steady, transparent way to build wealth over time. The fund's popularity comes from its straightforward approach: own a basket of America's most stable, profitable companies. SCHD has earned a reputation as one of the best dividend ETFs available. It's a favorite for retirement and income-focused portfolios. If you want simplicity, reliability, and growth, SCHD is a top contender. That's why everyone's talking about it. Let's see how it's been performing. Let's talk numbers. How has SCHD performed lately? In 2024, SCHD delivered a total return of about 12.8%, combining share price growth and dividends. That's impressive, especially given the year's economic ups and downs. In the first quarter of 2025, SCHD's price rose 3.5%. Steady, not flashy, but exactly what you want from a dividend-focused fund. SCHD's real strength is consistency. Over the past 5 years, it's averaged an annual return of 11.5%. Stretch that to 10 years, and you're looking at 12.2% per year. These numbers show SCHD's resilience and ability to create wealth over time. Its screening process, focusing on cash flow, low debt, and dividend growth, helps it weather market downturns better than many funds. While it may lag during tech-driven bull markets, SCHD shines when stability and income matter most. For long-term investors, this consistency is a huge advantage. SCHD isn't just about big returns, it's about reliable, growing returns. That's what makes it a core holding for so many portfolios. Now, let's get to the heart of SCHD, dividends. As of mid-2025, SCHD's forward yield is around 3.6%, much higher than the S&P 500 or a 10-year treasury. That means more income for you, whether you're reinvesting or using it to pay bills. SCHD pays dividends quarterly, making it easy to plan your cash flow. In Q1 2025, the fund paid about 68 cents per share, a healthy increase over last year. But the real magic is in dividend growth. Over the past decade, SCHD has grown its dividend by over 10% per year. If you bought in 10 years ago, your income has more than doubled. This growth comes from SCHD's focus on companies with a strong history of increasing payouts. The index requires at least 10 years of dividend payments and a solid 5-year growth rate. That means your income isn't just steady, it's growing. SCHD is designed to be a compounding machine for long-term investors. Bigger checks every year. That's the SCHD advantage. What's inside SCHD? Let's look at the top 10 holdings. These companies make up about 40% of the fund and are leaders in their industries. Broadcom, Verizon, Merck, Home Depot, and Chevron top the list, covering tech, telecom, healthcare, retail, and energy. Rounding out the top 10, AbbVie, Coca-Cola, PepsiCo, Cisco, and Amgen. This lineup gives you exposure to everything from consumer staples to cutting-edge technology. The diversity within these top holdings is key. No single sector dominates. You get stability from consumer and healthcare giants, plus growth from tech and energy. SCHD's sector mix helps it deliver consistent returns and reliable dividends, no matter the market cycle. It's a carefully balanced portfolio of America's most resilient companies. That's why SCHD can weather storms and keep paying out. You're not betting on one industry, you're investing in the backbone of the U.S. economy. That's smart diversification in action. How does SCHD compare to other popular dividend ETFs? The main rivals are Vanguard's VIG and VWAM. VIG focuses on companies with at least 10 years of dividend growth, but its yield is usually lower, around 2%. VWAM chases high yields, sometimes even higher than SCHD, but doesn't screen for quality as strictly. SCHD strikes a balance. It offers a higher starting yield than VIG and more quality control than VWAM. VIG may outperform in bull markets, but SCHD's blend of yield and safety is hard to beat for income investors. Unlike VUM, SCHD avoids yield traps by filtering for financial health. SCHD's hybrid approach, current income plus growth potential, sets it apart. It's not just about the biggest yield or the longest growth streak. SCHD combines both, making it a favorite for those who want reliable, growing income. That's why it stands out in a crowded field. For many, SCHD is the gold standard for dividend ETFs. Let's wrap up with whether it's still a top pick. So, is SCHD still a top choice for 2025? Absolutely. Its low fees, transparency, and disciplined strategy haven't changed. SCHD's focus on quality, dividend growth, and financial strength makes it ideal for building reliable income. The index it tracks ensures only the best companies make the cut. For retirees, the quarterly payouts and growing income are a huge plus. For younger investors, SCHD offers a solid foundation for long-term wealth. No investment is risk-free, but SCHD's track record speaks for itself. It delivers a rare mix of income, growth, and safety. That's why it remains a cornerstone holding for so many investors. If you want steady, growing dividends in 2025 and beyond, SCHD is still a top pick. Thanks for watching. Happy investing!